things like coordination of agents, feels like that's probably a Sui strength. So we will use different blockchains for different strengths, and over time it'll become interoperable. It's a word we use in crypto a lot. People don't really understand it, but simply speaking, you are in the US, I'm in the Cayman Islands. I have no idea what camera you're using, what microphone you're using, what operating system on your computer, what make of computer you're using, what internet connection you've got, nothing. I don't know anything, because all of that technology is abstracted away. I click on Riverside Studio and you're there. That will happen in blockchain.
Hey guys, welcome to Everyday Finance. Raoul Pal has spent years correctly predicting global liquidity cycles and their effects on Bitcoin. But even the most astute macro thinkers can be taken by surprise. He's acknowledging this time that the business cycle hasn't accelerated as he had anticipated. The economy has yet to reach the explosive stage he refers to as the banana zone. Despite massive money printing and unprecedented liquidity injections, and this might be the cause if you've been wondering why Bitcoin and cryptocurrency haven't taken off like they did in past cycles. Powell claims that because global liquidity hasn't sparked, we're in a stretched, extended cycle unlike anything we've seen before, and that Bitcoin's peak would occur in 2026, 2 years after the 2024 halving, rather than a year after the halving. Since growth is slow, interest rates are still high, and the ISM is still below 50. The cycle hasn't ended, it's just been prolonged. He thinks that one of the most powerful cryptocurrency bull runs in history may be triggered by this gradual accumulation. Powell contends that liquidity cycles are shifting, with slower but much larger waves forming in place of quick spikes. Despite the fact that some would use this as an excuse for the current lackluster price action, he anticipates that the liquidity surge he is monitoring will push Bitcoin, Ethereum, stocks, and even gold to all-time highs. It is not a minor ripple, but a huge tsunami that is still at sea. Powell continues to call for a 2026 Bitcoin peak and frames this setup as one of the greatest macro trades of all time. So it could be worthwhile to consider that this halt is really the calm before a very profitable storm, before assuming that this cycle has run out of steam.
The question is what drives the 4-year cycle? It was for a long while, people in crypto thought it was to do with the Bitcoin halving that happens every 4 years. And therefore there's a supply shock. But each year now, the supply shock is less each time. So it can't be the predominant driver. But then when you look at all assets, they're all driven by a 4-year cycle. And that was the cycle of the rolling or refinancing of the debts. So then if the structure of the debts is most important, what could have changed? Well, back in 2021 and 22, interest rates fell to 0 again. So they extended the duration out by a year and got it to about 5 years. So if debt maturity and the refinancing of it is the dominant factor, then if they've moved out from 4 years to 5 years, the cycle should elongate. And that seems to be what is playing out by all the forward-looking indicators that we use. It says that the cycle doesn't finish until maybe this time next year. So that's a brave call, but it's a probabilistic analysis. And when people say, yeah, but the famous words of this time is different, I'm saying it's not different. It's just based on the debt. It always was. So if it's based on the debt, nothing's changed. The debt maturity has been extended to 5 years. End of story. Yes, the business cycle hasn't picked up yet. And the business cycle is the strongest cyclical driver. So we've got the debasement, the printing of money, but really the business cycle has been subdued because interest rates have held high and other factors. So that is what surprised us. But this is really, it's a way of representing the elongated cycle. Normally the ISM would have picked straight up, and we would be now with the ISM at, let's say, 57 or something, looking for the peak. But we're not. We're below 50. But the forward-looking indicators suggest that it still continues as normal. So what we've done is taken a business cycle that's this long and stretched it out a bit longer. And what we've seen is this year was that. much like the Mag 7, we will have a group of layer ones that will be the foundational layer for this new internet. Bitcoin is not that, because it's not a smart contract platform. So it's its own asset that you alluded to before, which plays a very specific and important role. So then you've got the smart contract platforms, and they're driven by Lindy effects, which is how long have they been around and did they fail? Ethereum is the oldest. Now, Ethereum stores more value than anybody else. It has more active users than anybody else because so much is built on Ethereum. Even with the layer 2s, abstracting away some of that, the Ethereum ecosystem is gigantic. Also, because it's been around so long and there's so many validators of the network, it is the most secure. And therefore, things with the highest value will tend to gravitate towards Ethereum. That's why NFTs have mainly remained on Ethereum. Why? Because NFTs have been the most valuable single pieces of block space ever created, and they will continue to be so. Like the single piece, most expensive piece of canvas, cotton ever created, will be the Salvador Mundi painting by Leonardo da Vinci. Right? So, or the most expensive real estate, and whether it's Central Park in Manhattan or whatever it is, right? So that's Ethereum's role. Ethereum's role is probably a large part of the financial system because they need security. They need something that is less risky. It's been adopted for a while, been tested, has a large number of developers. But then Solana comes in, it's faster and cheaper. Well, that has a whole bunch of use cases. And what we've seen is the rise of speculation. But what that is the battle testing of simple stuff like, could equities go on chain? Should it be on Ethereum or Solana? Well, you could build a layer 2, but Solana is probably a more efficient way of doing it. So Solana, I think, for the transactional layer, as opposed to the storage layer, becomes pretty interesting. And that's probably where its strengths lie, the transaction layer. Then we've got the only other kind of really groundbreaking new technology at layer 1, which was Sui based on the Move protocol that came out of Meta. Sui goes one stage further. It's faster, cheaper than Solana is, but it has a different elements of how it uses smart contracts, things called objects, that gives the chain the ability to do a lot more. And for me, where Sui fits within all of this is, yes, you can do transactions, great. But really what it is the scale of the internet. Things like, if you decentralize a social media at scale like Twitter, X, the only blockchain that can handle that throughput is Sui. And it works perfectly because each post would be an object within the chain, everything else. So things like digital ID, things like gaming, things like social media, things like coordination of agents, feels like that's probably a Sui strength. So we will use different blockchains for different strengths, and over time it'll become interoperable. It's a word we use in crypto a lot. People don't really understand it, but simply speaking, you are in the US, I'm in the Cayman Islands. I have no idea what camera you're using, what microphone you're using, what operating system on your computer, what make of computer you're using, what internet connection you've got, nothing. I don't know anything, because all of that technology is abstracted away. I click on Riverside Studio and you're there. That will happen in blockchain.
Raoul's argument was simple when he first wrote about Bitcoin in 2013. When it was trading at roughly $200, he predicted that it will either crash to zero or serve as the cornerstone of a new international financial system. That call seems almost prescient now, 10 years later. Even more intriguing, though, is how his comprehension of the significance of Bitcoin has evolved over time. He was unaware of the effects of currency debasement at the time, which is the gradual loss of purchasing power caused by governments printing money to control growing debt. He now refers to cryptocurrency as the largest macro transaction of all time, because he believes it to be the most powerful macro factor in the world today. Rare assets like Bitcoin, gold, great art, and even rare cars are the ones that actually maintain or increase wealth in a world where major currencies depreciate by about 8% annually. However, Bitcoin is unique in that it is not only a store of value, it is also borderless, programmable, and designed for the digital era. Pal views it as immaculate collateral, a form of inviolable digital gold that becomes more potent as its network grows. And Bitcoin is just the beginning for him. He thinks that the entire cryptocurrency ecosystem will grow significantly as a result of smart contracts and layer 1 blockchains like Ethereum, Solana, and Sui.
Well, the value of a layer 1 is Metcalfe's law. It works for all of them. In fact, every crypto asset is driven by Metcalfe's law. There is no other way of valuing these things. And anybody who tries to do it will get it wrong. It's only Metcalfe's law. So, Lindy effect, think of it as the probability that people will use that chain. The longer it's around, the more likely it's to be used, if it's already being used. We've got a lot of assets out there, Cardano, that doesn't have any use. We've got a lot of holders, but no real use cases that people are using at scale. The Lindy effect in Cardano is because people have made money out of owning it, so they continue to own it, and it brings new people into that space. That's their Lindy effect. The Lindy effect of Ethereum is it's been around longer. It's gone down 95% twice, and yet the developers stayed. The network activity grew each cycle, so it now becomes de-risked. If you're JP Morgan, are you going to use Ethereum versus Solana? Probably. So that is Lindy effect. So Lindy effects compounds into Metcalfe's law. Because to show that you survive and thrive means that more people adopt it over time, which drives the metrics for Metcalfe's law. And that's all layer ones, all tokens are all driven the same way. In fact, 99% of technology stocks are driven the same way as well. It was always going to happen because they still want control. Will they win versus open source decentralized networks? I doubt it. But we've seen this with all sorts of things. Some things are open source, others aren't open source. So I think they will always try and maintain control over their networks. But at scale, they're less likely to do as well. So we'll wait and see. But it was obvious that we're going to go and try this. Obvious that they want their own closed network. So there's two parts of NFTs. One is the art side of NFTs. And the other side is, what does non-fungible smart contracts enable? The art side is the leading side. It's showing what happens is in a digital world, we ascribe things, digital things as now having value. Before blockchain, you can create infinite amounts of digital things. With blockchain, you can create scarcity. So digital things now have value. That's a huge breakthrough. We did that with money. You create a scarce money, it now has more value. That's Bitcoin. And with art, we've done the same thing. Digital art had zero value, and now suddenly it has immense value. And we've seen artists experimenting with NFT technology, what they can do, how they can get it to transform, what they, and we've seen that store of value has lasted. And we've battle tested the technology at scale via a massive NFT speculation boom last time around. But NFTs are so much bigger. Humanity is organized by a system of contracts. For you and I to turn up to this interview today, it was an email. But it's a contract. Hey, you'll do this and I'll do that. Every time you go into a shop, every relationship you have is basically a contract, including your marriage or whatever. Everything is a contract. An NFT is just a contract. It's a contract for a piece of digital art that is stored on chain, that you own it. It can be the contract for a house, title deeds of your car. More importantly, your own ID, or every ticket that exists. We will definitely use NFTs more than anybody has a comprehension of, and it will be the largest part of these crypto networks. And brands tried it to create loyalty and networks around brands. And many of them walked away because they don't have the long-term mindset and how to do it. And it's not easy. Everyone's experimenting. It was early. But let's say you're a company that has tickets. Let's call you Eventbrite. You've got 90 million users have no connection with each other. You can't give value back to the network. You can't create an easy loyalty system. You can't have people building on your network because it's not a network. It's a SaaS model of, hey, I just use your website and I can invite a bunch of people to a party or an event. Now, if you tokenize that, each one of those events becomes an NFT. We can see who's got what in their wallet. We can see, hey, Mark likes art events and music, and he also likes to go to these kind of bars. And before I know it, I've got a social profile of you, so I can deliver things of value to you. Or you can then connect, let's say you hold an event in New York City, everybody has an NFT, you know who they are, you're doing something different, or you've got a partner that wants to access that same group where there may be value, you can use the NFTs. If you think of the music industry, you can now do a lot with an NFT to permission people like you're a super fan. Hey, you've done this, you've gone to 5 concerts in a row, we're going to give you a special NFT. That NFT gives you right to early stage access to new music or front row seats. Well, now that has value. And you can either cash in the value yourself by using it, or you can sell it to somebody else. So you've spent 10 years being a Taylor Swift fan. Your NFT might be worth $25,000, $30,000 because you've been a super fan, but now you're kind of grown up and you don't like Taylor Swift anymore. You could sell it to somebody else and they get those rights. So you create super brand loyalty. You create a much better cohesion layer of social graphs on the internet. So brands don't realize it yet, but this is where everything will go. And it surprised me how slow it's been, but it will happen at scale. Mm-hmm. And that's where things like Sui come in again, because the scale of which they can do this is almost unprecedented. Solana's pretty good for it as well. But Ethereum, terrible for it. Ethereum's much better for really expensive NFTs, like your house. So that's how this is all going to play out.
Yeah, and Avalanche is also a lot of great applications in it.
Avalanche is great as well. Lots going on. And there's several, just because I use those, I mean, there's several blockchains, but not that many that are doing these kind of things at scale with great technology.
As the most secure and popular blockchain and the foundation for DeFi, NFTs, and tokenized assets, Ethereum today operates similarly to the internet's core infrastructure in the early 2000s, according to Pal. In the same way that Manhattan real estate draws the wealthiest purchasers, he thinks it will continue to draw the highest value activity. According to him, Sui, with its move-based design, might herald the next stage of blockchain performance, while Solana stands for the quick and effective as a transactional layer that may someday enable on-chain stocks and real-time payments. Pal suggests that cryptocurrency may soon unveil its own Magnificent Seven, drawing comparisons to the last significant digital revolution that gave rise to industry titans like Apple, Microsoft, and Nvidia. In the next 2 years, Bitcoin, Ethereum, Solana, and other prominent assets may reach levels that are difficult to fathom today if his elongated cycle theory is accurate. The recent downturn hasn't altered his belief that surprise is just an opportunity, that the cycle isn't broken, but rather changing. Everything still runs on liquidity, and he thinks 2026 will be the year that it finally roars to life.